A conflict is unfolding right now that will establish who dominates one of the most crucial metals on Earth for the next 50 years. It isn't being waged with weapons. It isn't being waged with embargoes. It's being waged with supply networks, processing facilities, and purchase contracts that most individuals have never encountered. And it's occurring right now in present time. While silver sits at $82 and most traders are still debating whether the drop to 64 was the conclusion of the bull market, it wasn't. The drop was a distraction. The actual narrative is what I'm about to reveal. Because what I discovered when I started investigating where the physical silver is actually moving, who is acquiring it, who is losing access to it, and why two superpowers are now competing to secure it completely transformed how I perceive this metal. And I think by the conclusion of this presentation, it will transform how you perceive it too. Welcome to the Concealed Financial System. If you're new here, subscribe. I examine what traditional financial journalism refuses to address. Also indicate in the comments where you're viewing this from, because I want to gauge how many individuals in this community recognize what is actually occurring beneath the surface. If you've been following this analysis, you already understand more than 99% of traders about what is genuinely propelling silver. If this is your initial presentation, welcome. You're about to witness something that will transform how you examine this metal forever. Let me begin with a question that nobody seems to be posing. Where does silver originate before it reaches the exchanges? Before it appears as a figure on your screen? Before COMEX reports it as inventory? Before London tracks it in their vaults? Where does the physical metal originate? Because the answer to that question is the foundation to everything I'm about to communicate. The answer is Latin America. Mexico, Peru, Bolivia, Chile, and Argentina together produce the majority of the world's extracted silver. These nations are ground zero for global silver supply. Mexico alone produces roughly 200 million ounces per year, making it the single largest silver-producing nation on Earth, although Peru follows close behind. Together, these two nations account for nearly 40% of all extracted silver globally. And for the past 5 years, while most traders were concentrated on price charts and futures contracts, China was quietly executing one of the most aggressive commodity acquisition strategies in contemporary history. And I overlooked it. I'll be honest with you. I didn't recognize this until recently. But once I recognized it, I couldn't ignore it. Here's what China was doing. Instead of purchasing silver on open exchanges like COMEX or the LBMA in London, where prices are transparent and everyone can compete, China went directly to the source. They went to the mines in Latin America and signed long-term purchase agreements. These are contracts where China agrees to buy the silver in its raw form, either as concentrate or as doré, which is a semi-refined bar that still needs further processing directly from the mine before it ever reaches a public exchange. Think about what that signifies. The silver was being purchased before it entered the global market, before price discovery. Before any other buyer even had an opportunity to bid on it, China was acquiring the metal upstream at the source and routing it directly into their own processing and refining system. The metal never appeared on COMEX. It never surfaced in London vault reports. It effectively vanished from the visible global supply network. I want you to visualize the flow because it matters. A mine in Mexico extracts silver ore. Normally that ore gets refined locally or shipped to a refinery in the US or Europe, where it becomes finished silver that enters the global market. Everyone observes it. Everyone can bid on it. Price discovery occurs. The system functions. But China inserted itself before that step. They stated to the mine, "We will purchase your concentrate directly. We will refine it ourselves in China, and we will compensate you more than anyone else will." So the silver departed Mexico, went straight to a Chinese refinery, got processed inside China, and never touched a Western exchange. Multiply that by hundreds of mines across 5 nations over 5 years. That's not a trade strategy. That's an empire strategy. They were intelligent about it. They offered Latin American producers higher prices and long-term certainty. If you're a mine operator in Peru and someone guarantees to purchase your entire output for the next 5 years at a premium, you accept that arrangement every time. But the cumulative effect of hundreds of these arrangements over 5 years is devastating because the visible supply of silver, the material that appears on exchanges and in inventory reports, got thinner and thinner and thinner, and nobody in the West seemed to notice or care. Stay with me because this is where the narrative gets remarkable. Something transformed, and I believe it transformed sometime in the second half of 2025. The United States awakened, and when I state the United States, I don't mean a politician delivered a speech. I mean the physical supply network started to shift. U.S. refiners began receiving unusually large volumes of silver concentrate from Latin America, so much material that refining capacity in the United States became overwhelmed. Metal was arriving faster than it could be processed. Let me repeat that because it's important. Silver was flowing into U.S. refineries faster than they could physically refine it. That's not a price signal. That's a supply signal. It signifies someone or some entity decided that Latin American silver was going to flow into the United States instead of to China. Historically, much of this metal would have been refined and shipped to London or forwarded to Asia. Instead, it's now staying in the Western Hemisphere. The flow has reversed, and the reversal isn't subtle, it's dramatic. What I believe is occurring is that the United States is now doing in Latin America exactly what China had been doing for 5 years, securing purchase agreements directly from producers, locking up supply before it reaches open markets, but doing it faster and with greater urgency. And here's the critical difference. The United States isn't just purchasing silver. The United States is squeezing China out of the Western Hemisphere's supply network. This isn't a trade. This is a resource conflict. And I need to tell you about something that occurred on Black Friday 2025 because it perfectly illustrates how this conflict is being waged. On that day, JP Morgan, the largest bullion institution on earth, effectively pulled silver off the market. They withdrew available supply. What followed was chaos. Someone in China who was structurally short silver, meaning they had obligations to deliver metal they didn't physically possess, was forced to cover their position aggressively. That wasn't a trade. That was a scramble. A desperate scramble to find physical silver that was no longer available through normal channels. And when the largest institution in America removes silver from the market and the largest buyer in Asia is forced into a panic cover, you're not looking at normal market dynamics. You're looking at financial warfare. Let me paint you a picture of what the Monroe Doctrine looks like in 2026. In 1823, President James Monroe declared that the Western Hemisphere was off limits to European colonial powers. It was America stating, "This is our backyard." 200 years later, the same principle is being reasserted, but this time it's not about colonies, it's about commodities. The United States is effectively communicating to China that Latin American silver supply is within the U.S. sphere of influence, and the mechanism isn't military, it's commercial. Secure the purchase agreements, overwhelm the refineries, control the flow, and let the market do the rest. Now, I want to show you a data point that genuinely astonished me when I first encountered it. And honestly, if you only remember one thing from this entire presentation, make it this. Because this is the moment where the picture becomes crystal clear. In any commodity market, when big buyers acquire material, they hedge. They lock in a price to protect themselves from volatility. This is what every textbook states should occur. This is what has always occurred. Until now, the hedging has disappeared. Commercial hedging activity in the silver market has declined materially. And once you comprehend what that signifies, you'll never examine this market the same way. Here's why. A buyer who hedges cares about price. A buyer who doesn't hedge cares about one thing only, possession. They want the metal. They don't care what it costs tomorrow. They don't care if it drops 20% next week. They want it in their vault, in their possession, under their control. Period. The disappearance of hedging is the single most bullish structural signal I've ever witnessed in any commodity. It communicates that whoever is purchasing silver right now isn't a trader, not a speculator, not a hedge fund running a momentum play. This is strategic, long-term nation-state level accumulation, the kind where price is irrelevant and access is everything, and the market is registering this. Prices move before policy. Let me state that again because it's one of the most important things I'll state in this entire presentation. Prices move before policy. The market isn't waiting for an executive order or a tariff announcement or a press conference. The market is watching the physical flows. It's watching the hedging data. It's watching the inventory reports. And it's pricing in a future where access to silver is more restricted, more contested, and more geopolitically sensitive than at any point in contemporary history. Now here's where China's desperation becomes visible. And this is the part where I need you to put your coffee down and really pay attention because as their access to Latin American raw silver tightens, their behavior has shifted. Reports have surfaced of Chinese buyers approaching producers and refiners in Latin America and offering to purchase finished silver, not concentrate, not doré refined, delivery-ready silver at $8 per ounce above spot price. $8 above spot. Do you comprehend what that signifies? At $80 silver, they're willing to compensate $90 for physical metal. That's not normal purchasing behavior. That's panic purchasing. That's a buyer who is losing access to supply and is willing to compensate whatever it takes to get their hands on the metal. Think about it from China's perspective. For 5 years, they controlled the upstream. They purchased the raw material at the source and processed it themselves. That pipeline is now being disrupted. So what do you do when you lose access to the raw material? You go after the finished product and you compensate a massive premium to get it. That's exactly what's occurring. China is bidding for finished silver at prices that make no sense unless you comprehend that their supply network is being squeezed. And at the same time, China announced that it will restrict silver exports starting January 1st, 2026. I covered this previously, but now I comprehend the full picture. China isn't restricting exports because they want to manipulate the market. They're restricting exports because they're losing the supply conflict and they need to protect what they have left. Export controls aren't offensive moves, they're defensive moves. They're the moves you make when you're losing. Now, let me connect this to something that most individuals completely misunderstand about tariffs. There's a law in the United States called Section 232, which allows the government to impose tariffs on imports that threaten national security. Most individuals think tariffs come first and then prices move. But that's backwards. In reality, the supply accumulation occurs first, then prices move to reflect the new reality, and then only after domestic supply networks are deemed sufficient, tariffs get announced to lock in the advantage. You don't tariff what you still need, you tariff what you already control. That's why silver prices can rise sharply without any official announcement. The market is front-running the policy. It's pricing in a future where the United States controls hemispheric silver supply and uses tariffs to formalize what the physical flows already demonstrate. JP Morgan and Goldman Sachs have both publicly flagged the risks of Section 232 implementation in metals. These aren't conspiracy theorists. These are the largest investment institutions on Earth, communicating to their clients to prepare for a world where metal flows get reshored and tariffs become part of the pricing structure. When JP Morgan communicates something is coming, you should probably listen. And there's one more layer to this that I think most individuals are missing entirely. And honestly, this is the part that keeps me up at night. It's the layer that makes this a truly global narrative, not just a US versus China narrative. Silver is becoming collateral in a de-dollarizing world. Here's what I mean in plain English. Right now, the global financial system runs on trust in the US dollar. But that trust is eroding. BRICS nations are building alternative payment systems. Central banks are dumping treasuries and purchasing gold at record pace. The question everyone is posing behind closed doors is simple. If the dollar loses its dominance, what backs the new system? Gold is the obvious answer. But here's the problem. There's not enough unencumbered gold to go around. Every central bank wants it. Every sovereign wealth fund is hoarding it. So what's the next asset in line? What is tangible, universally accepted, divisible, and already embedded in every industrial supply network on Earth? Silver. Not as currency you spend at the store, as collateral that sits on a balance sheet and backs real obligations. Think of it like the down payment on a house. You don't spend it. But without it, the arrangement doesn't occur. That's what silver is becoming in the new financial architecture. And that's exactly how I believe China views it. Not as a retail investment, as a strategic balance sheet asset. And that creates a type of demand that has never existed in the silver market before. Here's why this matters for price. And I mean genuinely matters. When silver was just an industrial metal and a precious metal for traders, the buyer base was limited. You had industrial users, jewelry makers, and retail traders, maybe a few hedge funds. That's a defined pool of demand against a defined pool of supply. But now add sovereign buyers. Add central bank adjacent entities. Add BRICS nations building alternative financial infrastructure who need collateral. Add the US government treating silver as a critical mineral. Add the Chinese government implementing export controls. The buyer base has expanded to include the most powerful financial entities on Earth, and the supply hasn't expanded at all. In fact, it's shrinking. 5 consecutive years of deficit. Vaults draining. New mine supply takes 7 to 10 years to come online. Even if you started today, more buyers, same supply, shrinking inventories. This isn't complicated mathematics, but it's mathematics that most individuals haven't done yet because they're still thinking about silver as a retail trade instead of a geopolitical asset. So, let me pull all of this together because I want you to witness the complete picture. And if you're still watching at this point, you're about to comprehend something that puts you ahead of 99% of traders on the planet. I want you to comprehend why silver at $82 isn't expensive. It's not overvalued, it's not a bubble. It's the early stages of a structural repricing driven by forces that have nothing to do with retail speculation or social media hype. Think about what's converging right now at the exact same moment in history. The United States is ripping Latin American silver supply away from China. U.S. refineries are so overwhelmed with incoming metal, they cannot process it fast enough. Hedging has vanished because the buyers don't want price protection, they want the metal itself. China is so desperate they're offering $90 for $80 silver. China is locking down exports because they understand they're losing. Section 232 tariffs are being modeled by JP Morgan and Goldman Sachs as a real scenario that would reshape global metal flows overnight. BRICS nations are building a new financial system that needs tangible collateral, and silver is next in line after gold. Central banks are purchasing gold at record pace, and the available unencumbered gold is shrinking, which pushes collateral demand down to silver. Vaults in New York and Shanghai are draining simultaneously. Lease rates in London are at 4.5%. The market is in extreme backwardation, and supply deficits have now persisted for 5 consecutive years, with no new mine supply coming online for another 7 to 10 years minimum. All of that at the same time. That's not one bullish signal. That's not two. That's every single signal in the physical market, the geopolitical landscape, and the financial system all pointing in the same direction simultaneously. I've never witnessed this many forces converge on a single asset in my career, and I don't think the market has even begun to price it in. I want to be honest about the risks because I never present one side without the other. I hold silver. I have involvement in this situation, and there are things I cannot perceive clearly yet. How exactly is the U.S. securing Latin American supply? Is this government coordinated or private sector driven? How will China respond? They could escalate with even higher premiums. They could pivot to African and Australian silver assets. They could weaponize their dominance in silver refining, which still processes a massive share of global output. And the timeline is uncertain. This could play out in 6 months or 3 years. Resource conflicts don't resolve overnight. I also want to address the obvious question. Is silver at $82 already too expensive? Let me reframe that question with what you now understand. Silver at $82 is the price at which it trades when Chinese buyers are willing to compensate $90 for physical metal. It's the price at which it trades when the United States is reclassifying it as a critical mineral. It's the price at which it trades when London lease rates are at 4.5% and the market is in extreme backwardation. It's the price at which it trades when two superpowers are literally fighting over who controls the supply network. Is $82 expensive, or is $82 the market still catching up to a reality that the physical world already understands? I'll let you decide. But I know what the data communicates to me. There's also a scenario that I think very few individuals are considering. What occurs if the United States actually implements Section 232 tariffs on silver? Let me walk you through the mechanics. A 25% tariff on silver imports would immediately create a price premium inside the United States. Domestic silver would trade at a significant markup to international prices. That premium would attract even more supply into the U.S., accelerating the drain from every other market on Earth. COMEX would become the destination of choice for every producer in the Western Hemisphere. London and Shanghai would witness their inventories collapse even faster than they already are. The tariff doesn't just raise the price, it reshapes the entire global flow of metal. And remember, JP Morgan and Goldman Sachs have both flagged this as a real risk. These aren't hypotheticals. These are scenarios that the largest institutions in the world are actively modeling. But here's what I do understand. The physical flows have transformed. The hedging data has transformed. China's behavior has transformed. U.S. refining volumes have transformed. And silver at $82 is sitting at the center of a geopolitical contest between the two largest economies on Earth, both of whom have decided that this metal is critical to their strategic interests. 5 years from now, individuals will look back at this period and they won't remember the crash from 121 to 64. They won't remember the headlines that stated the bull market was over. They'll remember this. The moment when silver stopped being a precious metal and became a geopolitical weapon. The moment when two superpowers decided that controlling silver supply was a matter of national security. And the moment when the price on your screen stopped reflecting what silver was worth and started reflecting how badly the most powerful nations on Earth wanted it. I'm not instructing you to purchase silver. I'm not instructing you to sell silver. I'm showing you what the data communicates to me. I hold silver. I hold extraction stocks. I have involvement in this situation. And the reason I hold them is because of everything I just communicated, not because of a social media thumbnail or a prediction, because the physical flows, the hedging data, the geopolitical positioning, and the inventory data all point in the same direction. And when every signal converges, I pay attention. If you've watched my entire analysis from the beginning, you now have a complete picture. Part 1 showed you the vaults draining. Part 2 showed you the price pattern that points to $300. Part 3 showed you why the crash was a leverage flush, not a fundamental breakdown. And this presentation showed you the geopolitical conflict underneath all of it, the conflict that's actually driving everything. If this presentation transformed how you think about silver, drop what you think in the comments. Send this to one individual who thinks silver is just a shiny metal with no strategic value. They need to witness this. The vaults are draining. The supply networks are flipping. The superpowers are fighting. And silver at $82 doesn't even begin to reflect what's occurring underneath. Here's what I'll be watching in the coming weeks. And I want you to watch them with me because if this hypothesis is correct, each of these 5 things will confirm it in real time. U.S. refining bottlenecks. If they persist, the supply network flip is accelerating. Chinese premiums over spot. If they keep climbing from $8 to $10 to $15, the desperation is growing. Section 232 developments. Any whisper from the White House or Commerce Department about silver tariffs, treat it as a fire alarm. COMEX and Shanghai inventories. If the drain accelerates, everything in this analysis is playing out exactly as the data predicted. And the gold to silver ratio, if gold pushes toward 8,000 and that ratio compresses, the mathematics for $300 silver becomes a fact, not a forecast. Watch those 5 things, and you'll witness this narrative unfold before the rest of the world figures out what occurred. This narrative isn't over, it's just beginning, and I'll be here every week to walk you through it. This is the Concealed Financial System. I'll see you in the next one.